Welcome to the deep dive. If you've been keeping an eye on personal finance lately, maybe you've noticed something a bit, well, contradictory in the numbers.
Yeah, it's quite striking.
We're jumping into individual savings accounts, ISAs, today, because honestly, the data we're seeing shows these really interesting, almost conflicting shifts in how people are using them right now.
It really is fascinating. For years, it felt like the story was simpler. Either you wanted cash safety or you chased equity growth.
Right, one or the other.
Exactly. But the current climate, higher interest rates, but also these nagging inflation worries, it seems to have pushed people towards a more segmented approach. And that's what we need to unpack today.
Definitely. We're seeing like two strong trends happening at the same time.
Yeah, powerful ones.
So our mission today really is to cut through that complexity. We want to quickly distill what's going on with cash ISAs versus stocks and shares ISAs.
Figure out the why behind each trend.
Exactly. And crucially, pinpoint that bit of strategic thinking, that sort of allocation knowledge that the data suggests maybe most people are missing right now.
It's like the current environment is making people want both immediate safety and kind of aggressive long-term growth hunting, almost pulling them in two directions.
Yeah.
So we'll dig into why both are happening and, importantly, how you might think about using both tools strategically.
Okay, let's start unpacking this. And the place to start, I think, is the big headline grabber. The data is just crystal clear on this one. Cash ISA inflows. They're at record highs.
Yeah, absolutely record levels.
We're talking a serious amount of money flowing back into these accounts. Accounts that, let's be honest, were kind of gathering dust for the best part of a decade.
Well, it's a classic market response, isn't it? Why are they suddenly so popular again? It's simple. They're finally offering what you might call a real return.
Okay.
For ages, interest rates were practically zero, sometimes even negative after inflation. But now, you're seeing rates of, 4, 5, maybe even pushing 6% sometimes.
Right. Numbers we haven't seen in a long time.
Exactly. And that's genuinely attractive. It offers real capital preservation, at least over the short term. That's the key driver.
That makes perfect sense, doesn't it? I mean, if you've got money you know you'll need in, say, 3 years,
Yeah.
and you can lock in a 5% return guaranteed, why would you put that specific cash into a volatile market?
Precisely. It gives you that liquidity, that security, things that suddenly feel really valuable again when rates are decent.
So if we look at the psychology, the behavior behind it, it's people prioritizing safety, short-term returns.
Yeah. Safety, liquidity, short-term thinking. It's a very rational decision, actually, given the current interest rate cycle. People are jumping on a tactical opportunity.
Tactical. Good word.
They're saying, okay, I've got funds I might need fairly soon, maybe an emergency pot, house deposit, car fund.
Right. Specific short-term goals.
And instead of just letting inflation chip away at it in a current account, I'll lock in this guaranteed yield while I can. It's money earmarked for the near future.
Okay, so a very tactical security-first move.
Yeah.
But, and this is where it gets really interesting, like you said, that's not the whole picture, is it?
No, not at all.
Because despite this massive surge into cash ISAs, stocks and shares ISAs are also seeing continued pretty strong growth.
And that simultaneous movement, that's the paradox we're seeing in the latest data. Record cash going in and continued appetite for investment growth.
It suggests people aren't just thinking about safety nets.
Exactly. While they're drawn to the short-term security of high cash rates, they also seem acutely aware that, well, cash alone isn't going to cut it for building long-term wealth.
That's such a crucial distinction. So if the cash motivation is, like you said, security and grabbing that short-term yield, what's driving the ongoing investment into equities? Are people just, I don't know, ignoring the easy 5% on offering cash?
They're looking beyond it. The motivation for putting money into stocks and shares, it isn't about the next year. It's about the next 20 or 30 years.
Right, the long game.
People are still investing because they fundamentally get that today's attractive cash rates are, well, probably temporary. They're transient.
Okay.
The analysis suggests this continued equity investment is driven by that basic need for returns that will significantly beat inflation over the long haul. Over decades, equities compound. They offer a much better hedge against inflation than any cash IS can, no matter how good its rate looks today.
So it's like we have two different pots of money emerging. There's the tactical cash, chasing today's high rates.
Yep.
And then there's the strategic money, positioned for decades of potential compounding growth.
That's a great way to put it. Let's just really nail that contrast.
Okay.
Cash ISA growth is fundamentally a tactical reaction. It's responding to the current interest rate advantage, locking in a temporary high yield.
Yeah.
It moves with the rate cycle.
Reactive. Got it.
Yeah.
And the stocks and shares ISA growth.
That's more of a strategic commitment. It's proactive. It's aiming for that long-term inflation-beating growth. And it means accepting some short-term bumps along the way as the price you pay for that eventual compounding.
So people are realizing they kind of need both tools, but for totally different jobs.
Exactly right. They're not interchangeable. They're specialized. One for now, one for later. And this realization that both are necessary, that actually brings us to what the data suggests, is the critical missing piece.
Ah, okay. The gap in understanding.
Yeah.
Let's shift to that then. Because if people are sort of intuitively putting money into both types of ISA,
Yeah.
it suggests they grasp the basic idea, right? Safety versus growth.
To some extent.
But what exactly is the strategic knowledge that's often missing? What's the big opportunity here?
The biggest opportunity highlighted is essentially the lack of a proper strategy for how to allocate between them. How much goes where and why.
Ah, okay. So people using both buckets.
Yeah, filling both up.
But maybe without a clear plan, like maybe splitting the allowance 50-50 just because it feels balanced. Or maybe just chucking money at whichever one did well last year.
Precisely. That's kind of random, isn't it? It's not strategic. The sources aren't saying people are making the wrong choice by using both. They're saying the way they decide how much goes into each is often just guesswork.
Right, so the how much and the why for each pot needs more thought.
Exactly. The goal isn't just picking a product, it's matching the product's strengths to your own financial timeline. And this is where we need to get specific about what balance really means in practice. It's not just 50-50.
Okay, let's define that strategy. So say I've got a lump sum, or I'm figuring out my monthly contributions. How should I decide how much goes into that tempting cash ISA versus the, potentially more volatile stocks and shares ISA?
Well, the fundamental rule, and this is probably the most critical takeaway, it comes down to your time horizon. When do you need the money?
Okay, time horizon.
The job of the cash ISA is liquidity and your short-term buffer. Any money you absolutely positively need within the next, say, 5 years. No arguments. That probably belongs in the safety and, right now, the high yield of the cash ISA.
That's the tactical bit.
That's the tactical bit of your financial life, yes.
So if I know I want to buy a car in 4 years, or maybe I just want an 18-month emergency fund, that money goes into cash to lock in these current rates.
Correct. For that money, you willingly accept the lower potential long-term return of cash. Why? Because you're getting 100% principal protection and zero volatility in return.
You're essentially paying for certainty.
You are. You're paying an opportunity cost, the potential equity growth you might miss out on, but you're buying certainty. And for short-term goals, that certainty is priceless.
Okay, but hang on. If things look a bit uncertain right now, maybe the market could dip. Why wouldn't I just extend that safety net? Say, keep money I might need in 6 or 7 years in cash, too. I mean, 5% every year with no risk sounds pretty good compared to maybe, 7% average in the market, but with scary drops.
That's a really common question. And it gets right to the heart of inflation risk and sequencing risk. Look, 5% today feels great, no doubt.
Yeah.
But remember, most long-term goals, like retirement, they span decades, 30, 40 years sometimes. If you keep money you actually need for the long term sitting in cash, even earning 5%, you basically guarantee that inflation will erode its real purchasing power over those decades.
Ah, okay. Even 5% might not keep up long term.
Historically, cash just doesn't consistently beat inflation over very long periods, that 5-year boundary. It's generally used because beyond that point, the risk of your money losing value to inflation usually starts to outweigh the risk of short-term market ups and downs.
Okay, I see. So for the really long-term funds retirement, maybe leaving something behind, anything needed 10, 20, 30 years out.
Yeah.
The deciding factor isn't today's interest rates.
No, it's the power of compounding and the absolute necessity of fighting long-term inflation.
And that's the job of the stocks and shares ISAs.
Exactly. That's its strategic function. You use your long timeline as your advantage. You ride out the inevitable market dips, focusing purely on the potential for compounding growth over many years.
That's how you aim to grow your money faster than inflation, which is key for building real wealth over time.
Precisely. And getting this synthesis right, using attractive cash rates tactically for the short-term stuff, and using equity strategically for the long-term growth, that seems to be the mental leap people are finding tricky right now.
Yeah, it really pulls all the threads together, doesn't it? The fact that both types of ISA are growing shows people kind of get they need both safety and growth. But the smart decision is about defining the job, defining the time horizon for every single pound you put away.
And this strategic thinking has immediate practical uses. If you're a young saver just starting out, maybe your allocation is heavily skewed towards growth. Maybe 90% stocks and shares, 10% cash, just for that emergency buffer.
Long timeline.
But if you're getting closer to retirement, that ratio flips dramatically, doesn't it? Your long-term money starts becoming short-term money. It needs more security.
So the balance isn't a fixed number. It changes over your life.
It's dynamic. It's all about that time-based allocation.
It really shifts the question, doesn't it, from just which ISA should I pick to, okay, what is this specific bit of money for, and which ISA is the right tool for that particular job.
Exactly. And understanding why cash rates are high right now is also key for what comes next.
How so?
Well, these high cash rates, they're a direct result of central banks trying to fight inflation, right?
Yeah, monetary policy.
So when inflation is eventually seen as under control, those interest rates will come down again, potentially quite quickly.
Which means that tactical window, the big appeal of the cash ISA right now, it's tied to the interest rate cycle. It won't last forever.
Whereas the strategic opportunity for the stocks and shares IS, that's defined by time itself.
Yeah.
Decades.
You summed it up perfectly. The market's showing record interest in security, driven by these temporary high rates, but also this permanent need for growth, driven by long-term planning realities.
So the most valuable bit of knowledge right now, it's figuring out how to strategically balance these two complementary tools, making sure every pound you contribute is doing the right job for you.
Okay, so that leaves us with a final thought for you, the listener, to maybe chew on, based on everything we've just discussed. Since the big draw for cash ISAs right now is totally linked to where interest rates are, what critical thinking should you be doing now about when those rates might start to fall?
Yeah, looking ahead.
Don't just wait for the headlines. What signals could you be watching? Maybe things like government bond yields or shifts in central bank forecasts. What might tell you that the window for these attractive cash rates is starting to close?
And how does that signal potentially trigger your own strategic decision to maybe start shifting more of your future contributions back towards the long-term growth engine, the stocks and shares ISA? Thinking ahead, planning proactively based on those signals, that's probably what separates the really savvy saver from someone just reacting to last year's news, right?
Absolutely. It's about anticipating the end of this tactical cash advantage so you're positioned correctly when it happens.
Definitely something to mull over this week, perhaps, as you look at your own ISS setup. Thanks for joining us for the deep dive.